Hello and welcome to my InvestEngine portfolio update for January 2025. I'll take you through both my stocks and shares ISA and relatively new self-invested personal pension. We're going to jump straight into the update with this one, as I did go through the market news in my Trading 212 update, and in this video I instead want to focus on the portfolio itself, analytics, and possible changes that could be made, and just reflections on the portfolio overall. So here we are in my InvestEngine account. The first thing you might notice here is that I only have the DIY ISA now. The managed ISA is no longer there. And that is because, as I briefly mentioned in the last update, I was thinking of selling managed ISA and I have gone through with that. And that's because I am a DIY investor. I only really had that managed ISA to showcase it on this channel. And I've held it since November 2023. So it had been over a year. And I thought enough is enough with that. I just want to have it super simple, get rid of the managed ISA and move the cash into the DIY ISA. Now, I was considering moving it in from the managed Growth 10 portfolio to the Life Plan 100% equity portfolio. But then I realized when I actually went there that the Life Plan 100% equity is pretty much the exact same ETFs as the Growth 10 portfolio. So I wouldn't actually be showcasing anything different by moving my investments into that. So in fact, I think it is exactly the same. So I don't think there's any difference between Life Plan 100% equity and the Growth 10 managed. So there'll be no point moving that around. Anyway, so the other thing to notice here on this homepage is the remaining allowance is above £20,000. Now, I went through this last time, but just to summarize that again, it's because InvestEngine is now a flexible ISA. And at the start of this tax year, I withdrew about £3,500 or £4,500 from a money market fund that I held in my ISA for a short-term savings for part of my house deposit. I withdrew that, and that meant that that withdrawal got added onto my ISA allowance with the flexible ISA rules now. And now the problem is that InvestEngine says I have £21,193 to use, but I actually don't, because as you may know, I've deposited on Trading 212 and Hargreaves Lansdown £17,500. So we actually have to take away £17,500 to get my actual allowance, which is about £3,600. So we do have some nice allowance to play with. I don't know if I'll be able to max out the ISA, but we'll see how it goes. Anyway, now jumping into the DIY ISA and looking at the ETFs and the performance, the first thing we'll see here is it has been an incredible month for the stock market, with my maximum returns now on this DIY portfolio being at plus £5,155 plus 33.34% on a time-weighted return basis. And if we just switch to that 1 month chart now, we can see over the past month alone, my portfolio is up by £896 or 3.35%. Now, these black dots here are the transactions. So we can see on the 3rd of January, I topped up my portfolio by £400, and that was just split across the 5 ETFs. Then on the 24th of January, this is me selling the managed portfolio and moving the funds into the DIY portfolio. So £129, that's a good way of seeing, because in November 2023, I deposited £100. So from November 2023 to January 2025, I got a 29.26% return. Not too bad. And then we have 5 buys, £200 on the 27th of January. So this is a £200 top up by me, split across the 5 ETFs. And then the final transaction was 1 buy, £12.06. And that was actually a dividend that I received from ISP6, just reinvesting that. And rather than splitting that dividend across 5 ETFs, because it's quite small, I just reinvested it straight back into that one ETF. Okay, if we just go to the 1 month chart again now and scroll down, we can see how the ETFs have performed over the past month. So the first thing to notice here is that XDEQ and GGRG have both done very well, but importantly, GGRG for the first time in a while has outperformed XDEQ. Now, as I've referenced a few times, GGRG has struggled over the last year or two because it is underweight Nvidia, and Nvidia has obviously been flying. But of course, over this past month, Nvidia hasn't done as well, so GGRG has actually outperformed XDEQ. If we just click into GGRG here and scroll down to the holdings, we can see that Nvidia only has a 2% weighting at the moment, which is much lower than a standard global ETF. And it's actually much higher than what it has been. I think about a year ago, or even months ago before GGRG rebalanced, it was only like a 0.1% weighting of Nvidia. So if we go back here, the next ETF in the portfolio is UC99, the USA Quality Factor ETF. That is only up by 2.28%. And I think the reason why that has lagged is because it does have a significant weighting to Nvidia, which for the first time in a while hasn't been doing the best, whilst the rest of the market has been doing quite well. Yeah, 8.3% Nvidia. Next up, we have the iShares S&P Small Cap 600 S&P 600 ETF up by 2.21%, and then finally Emerging Markets ETF up by £25, 1.29%. So it is surprising that emerging markets has done so poorly in comparison, because you'd think with all the hype around DeepSeek AI and Chinese companies in general developing their own AIs, maybe they would do quite well, but apparently not. Emerging markets still lagging developing markets. Okay, I'll just switch to the maximum view now, and we can see how all the ETFs have performed. So just to quickly summarize, I've held all these ETFs since November 2023, apart from UC99, which was added in February 2024. And the weightings have flicked around a few times, so that's why some of these returns may not stack up. It's because I have edited the portfolio a couple of times. So what we can see here is that XDEQ is the best performing ETF by quite some way. And then GGRG, the gap between the two has narrowed a bit now, but of course GGRG is underperforming XDEQ slightly on a time-weighted return basis. Due to that, as I say, Nvidia underweight. UC99, 16.72% since February 2024. That's very good. The S&P 600 ETF small caps have done well. It did take some time to get going with those small caps. You might remember me saying that I included this because they were relatively cheap compared to large caps, and they stayed cheap for a very long time. They have caught up now, but it's not been anything spectacular, but that's the thing with satellite positions and small caps. They're more volatile, they have long periods of underperformance, but then when they do outperform, they can have significant outperformance. So maybe that will come, maybe not. We'll have to wait and see. And then emerging markets has done the worst, considering I held that since November 2023. Okay, let's click into the self-invested personal pension now. And I know I'm not very creative here with the names. I've just called them ISA and SIPP. If you have any ideas of what I can call these portfolios, let me know in the comments below. Okay, so thing with this self-invested personal pension is that I first tried out the InvestEngine SIPP in January 2024, but it was only £100. So that's kind of distorted the time-weighted return here. So it says plus 21%, plus £228, and you may think 21% of 4,900 isn't 228. Well, that is just because it's time-weighted return, and all of my contributions have been in the last couple of months. So just to explain that quickly, that's why the time-weighted return is what it is. Okay, if we scroll down in the maximum view and just quickly look at the ETFs, it's a super simple portfolio here. ACWI, a global index fund. If we click into this one, it does have a total expense ratio of 0.12%, so it is the cheapest global ETF on the market at the moment, as far as I'm aware, for UCITS investors. And the reason why not many people know about this one is that up until August 2024, it had a total expense ratio of 0.4%. So State Street slashed the fee from 0.4 to 0.12. So just like that, it went from being the most expensive global ETF, or one of the most expensive, to one of the cheapest, if not the cheapest. And the good thing about a fee cut rather than launching a new ETF is it means it already has a decent fund size. Unlike with FWRG, that was a brand new ETF, so the AUM was quite low. This one already has a high AUM because the fee has just been cut rather than being launched new. If we just switch to the 1 month view now to look at the portfolio, it has been a case of ACWI, the global index fund, outperforming small caps. And the reason why I went with RTWP in this portfolio rather than ISP6 is because I wanted an accumulation small cap ETF, and ISP6 unfortunately is distributing. And accumulation means those dividends are automatically reinvested, means my SIPP is completely hands off, which is what I want for my super simple SIPP portfolio. And then the last thing to mention here is I do have a savings plan of £100 per month going into this SIPP. I kept it at a relatively low bar because I want to be able to consistently contribute without straining my finances too much, because my income does fluctuate as having these side hustles, and if I have a particularly good month I can manually top up my SIPP, but because it's not fixed income, I don't know what I'm going to make month to month. It would be silly of me to increase that more than £100 per month. So but it is nice to have that basic top up in there in the background and know my pension is working away in the background regardless. Okay, and the last thing I wanted to go through in this portfolio update is the future plans for the portfolio and how I can potentially simplify it further. As you may know, I make things probably a bit more complicated than they need to be because I do enjoy factor investing, trying out different ETFs. But the thing is, that's not the ideal situation for me. Ideally, I do want one global developed markets ETF and then having a few satellite positions as well, because I do enjoy experimenting with those different satellite positions. So how I see my portfolio at the moment in the ISA is the core is those two quality factor ETFs, GGRG and XDEQ, 70% weighting. And then the satellite positions are the USA quality, slightly overweighting USA, US small caps, overweighting US small caps because they're relatively cheap, and then emerging markets, small exposure. I like to have that separate from my developed markets. But then again, I'm going to talk about that in more detail because I am considering changing that. Okay, so the problem with having a core split across two ETFs is it's a bit too complicated, really. I'd rather have just one global core. And because I want that quality factor exposure, the problem is that XDEQ and GGRG, neither of them are perfect. They're probably the best quality factor options we have. There's not that many to choose from, really. But the problem with XDEQ is it tracks a sector neutral index. So it kind of does cap the potential upside of the quality factor by capping those sectors. If some sectors have higher quality companies in them, I have no problem with overweighting those sectors. So I would much prefer XDEQ to track the standard MSCI World Quality Index, which has performed much better historically. So it is is annoying it tracks sector neutral, but in absence of a standard one, it's the best we can get. And then GGRG, this is another good one. It has lower volatility than other options, but that's also its downside. Its lower volatility comes from the fact that it only includes dividend paying quality stocks, and also it's weighted by total dividends paid. So if a company pays no dividends or little dividends, it will have very little weighting in the ETF. And that is why GGRG has performed quite poorly over the last year or two in comparison, because it is weighted by total dividends paid, and Nvidia relatively doesn't pay much in dividends. It has underweighted Nvidia significantly and lags behind, and Magnificent 7 stocks in general that have done well, GGRG has underweighted. So that's it really. There's problems with each of these quality factor ETFs. So my potential solutions here are wait for a better quality factor option to come out, which may never happen, because I have contacted a few ETF providers to ask them, and they do say they have no plans at the moment, which is a shame, but hopefully one of them eventually will do that, because they have one in Australia, like the VanEck MSCI World Quality ETF. They have that without sector neutrality in Australia, and it's performed very well. So I don't know why they wouldn't launch it in the European market. Maybe one day. The other options are to scrap the quality factor and go with something like ACWI, because it is incredibly cheap global index fund at 0.12%. And that links me on to EMIM, the emerging markets ETF. This one has a total expense ratio of 0.18%. And it just doesn't sit well for me paying 0.18% total expense ratio for an emerging markets ETF when I can get a global ETF developed and emerging for 0.12%. So I don't know what I'm going to do about that, but I just feel like it is a bit silly paying a higher total expense ratio for just emerging markets when you can get global for cheaper. So the options so far: wait for a better quality factor ETF come out and stick with these two in the meantime. Second option is switch to ACWI. And then the third option is consider other developed markets ETFs. I'm thinking stuff like JGRE or SWLD, other developed markets options to make this more simple. But I'm basically just having an open discussion here. I'm leaning towards just keeping it as it is because it's not doing poorly. I'm not unhappy with the portfolio. It's just that I would rather reduce the amount of ETFs I have in the portfolio for the long term, just to make it more simple. Simple is better in my opinion over the long term in investing. And then the last thing I'll just do is quickly go to the analytics. So if we go to the analytics here, this is all portfolios from ISA and SIPP, £30,500. We can see it is 65.5% North America, 11.4% Europe excluding UK, 3.9% Japan, Asia ex Japan, 3.7% UK, 3.2% emerging markets. Now I do think InvestEngine defines emerging markets slightly differently, because it doesn't make too much sense for emerging markets to be 3.2% when I have ACWI and the emerging markets ETF at 8% in the main portfolio. So I'm not sure how InvestEngine define emerging markets, but it's interesting to see nonetheless. Japan 2.9% and so on. And if we just switch to holdings, it's very similar to what you'd expect. The top three holdings: Apple, Microsoft, Nvidia. But then beyond that, beyond the top three holdings, my portfolio does differ quite a bit from a standard global index fund. A lot of well-known companies, just in a different order to what you're probably used to seeing in a simple global index fund. Like companies like Visa, Meta, Procter & Gamble, Eli Lilly, MasterCard, they're all massive companies. They're just usually not in this order and so high up. But as I always say, the analytics feature on InvestEngine is one of my favorite features. And I do find it so cool to see how much money I have indirectly in each of these companies through my ETF holdings. Seeing the pound value is quite unique to InvestEngine. I don't think there's another platform that does it quite like it. So that is it for this portfolio update. I'm excited to see what February has in store for us. Obviously, the big news at the moment is Trump's tariffs and how that's going to impact the market. At the moment, my portfolio is doing pretty well. I am expecting a bit of a dip as those tariffs come into play and the market reacts to that. But as a long-term investor, I'm just going to keep on contributing, not worry about tariffs. We've had these before. They come and go. I've got decades to invest. It's nothing to worry about. Keeping up consistent contributions is the most important thing. If you like this content, be sure to like and subscribe for more. Thank you for watching.